This is Options for Strategic Investors Understanding Put Options, a beginner's guide. This video is for educational purposes only and not investment advice. In simple terms, a put option gives the holder the right, but not the obligation, to sell an underlying security at a predetermined price on or before a specific date. An investor would buy a put option if they were concerned about downward price movement by the underlying stock. And it can be a very useful tool for scenarios when you believe a stock's value is likely to fall. Just like their counterparts, call options, all put options are defined by the same basic terminology. You have the underlying security, which is the specific stock that the option contract is for. You also have the strike price, and this is the fixed price at which the holder of the put option has the right to sell stock. And then you have the expiration date. This is the date after which the option contract is no longer valid. So how can you profit from a falling stock price? The core principle behind buying a put option is simple. The buyer of a put is hoping for a stock price decline in order for their put option to become more valuable. If the stock price falls far enough below the option's strike price, the put holder can realize a profit. Let's hop into the Thinkorswim trading platform here and look at a real example of why someone might use a put option. I am long 100 shares of Oklo that I purchased for $49. I'm sitting on a profit of 238% for an unrealized gain of just over $11,000. When we take a look at a chart of Oklo, we can see the dramatic price appreciation that the stock has experienced over the course of the last few weeks. It's been quite dramatic. And my concern is that the price is going to fall, but I'm not quite sure if that's really going to happen or not, but I have a concern, so I want to protect my profits. Therefore, I decided to purchase a 150 strike put option, and I paid $7.40 to make that purchase. That means that if my shares fall below $150 per share, I have the option to exercise that put and sell my shares for $150 per share. When we head into the risk profile software, we can see that the x-axis represents the price of Oklo, and the y-axis represents the profit or loss of the position that I have highlighted in the risk profile software. And you can see here that I am showing 100 shares of Oklo and one long 150 put. The purple line represents the theoretical value of the position as it stands today, and the blue line represents the value of the position at expiration, which is October 24th, 2025. So essentially, I am long 100 shares, and I am also long one protective put with a 150 strike price. And we can see here that this would allow me to continue to participate if Oklo continued to move to the upside. But it would also lock in a minimum profit for me of $9,357. And that's because it would allow me to sell the 100 shares of Oklo at $150 per share if Oklo were to trade down below that value at expiration. And we can see the values change as I move up the graph there. And now let's take a look at what that graph would look like if I just owned stock outright. And you can see here that the position beyond the 150 price point would just continue to decline. So it would eat away at my profits unabated until I hit my break-even point, which would be around $49 per share. Now, when I select the put option, we can see the shape of the graph changes back to the original graph that we were analyzing. Now let's head into the simulated trade section of the software here and bring up risk arrays. So I'm going to open up the price slices tab, and I have Oklo populated in the software here, and we can see my position is highlighted below where I'm long 100 shares of Oklo, and I also am long one 150 strike put option. Those are the two positions I have selected in the software. And I have the ability to set price slices in the software, which is basically an assumption of where the price of Oklo will be. And it shows my Greeks for the position highlighted, as well as the profit and loss for the day. So I can see how my position would do under various scenarios, given price changes in Oklo. And the price changes that I have populated are 10% increments up to 50% and down to 50%. And we can see here that if Oklo fell 50%, the total value of my position would be a little over $9,000. And when I deselect the put, we can see that the position would lose value because that protective put wouldn't be there. Now let's look at the upside impact of the put, and you can see it's minimal. So the upside impact that the put has on the position is simply the cost to purchase the put, which in this scenario is $7.40. And what's nice about this software is you can play with volatility adjustments. So if you thought that Oklo was going to fall 50%, you would assume that implied volatility might jump 10 or 20 points for the options that you're holding. And you can select those assumptions and it will show you how the position would behave under those scenarios. You can also play with the dates to expiration. So you can see how the position would behave as you get closer to expiration. Now let's take a look at just the put alone. So let's assume I don't own 100 shares. What would this put look like if I just simply was bearish on Oklo and wanted to speculate on that assumption and bought a put? You can see here that as Oklo would trade under $150, the value of that put option would increase. So the value of a put option is inversely related to the price of the stock. And the loss would be limited if Oklo is trading above $150 per share at expiration. The most I could lose was what I paid for the put option, which in this case would be $740. When I select the 100 shares again, we can see the shape of that graph change. The price of a put option, often called its premium, is composed of two distinct parts, its intrinsic value and its time value. Intrinsic value is the real value an option has if it were exercised. For a put option, the value exists only when the stock's price is below the strike price or when the option is considered in the money. If a put is out of the money, meaning the stock price is above the strike price, its intrinsic value is zero. And that's because why would someone exercise a put to sell a stock at, say, $130 per share if they could sell it in the open market at $170 per share? It just wouldn't make any sense to do so. Therefore, the out-of-the-money options would not have any intrinsic value. The formula for an in-the-money put option's intrinsic value is equal to the strike price minus the stock price. So let's head back into the software where I'm going to highlight the Trade tab, and I'm going to open up the October 24th, 2025 options expiration cycle because that is the expiration for which I hold the 150 strike put option. I'm going to reduce the number of strikes displayed in the options chain just for the ease of demonstration. And I'm going to scroll down and we're going to see that I have one 150 strike put option in this options expiration cycle, and that's highlighted in the position column. And we're looking at puts. We'll notice that the strike prices that are trading above the current price of Oklo, which is $170, are highlighted in kind of a bluish gray, and that represents in the money. The options trading below the current market price of Oklo are highlighted in black, and my 150 strike put option is considered out of the money. It does not have any intrinsic value because why would I exercise the put to sell my shares for $150 per share when I could sell them for close to $170 per share and actually $167 per share pre-market? And when I bring up the intrinsic value column in the software, we can see that all out-of-the-money options have zero intrinsic value, and in-the-money options have intrinsic value that grows the deeper in the money they get. Time value, otherwise known as extrinsic value, is any value the option has in excess of its intrinsic value. It represents the price investors are willing to pay for the possibility that the option will become more profitable before it expires. For an in-the-money put, the time value premium can be calculated as follows. You take the price of the put option and add the stock price, then you subtract the strike price. Time value is largest when the stock price is exactly at the strike price, otherwise known as at the money. And as the options get deeper in or out of the money, this premium shrinks. Let's move back into the software here, and I am going to change the position column to extrinsic value so that we can highlight what we just discussed. And the software here does the calculation for you. And you can see the extrinsic values listed per strike price in the extrinsic column. And remember, the current price of Oklo pre-market here is $168. And that means the 165 and 170 strike prices are at the money. And you can see they have the largest extrinsic values. And as you move further away from at the money in both directions, extrinsic value decreases. Now let's talk about using your option, exercise and assignment. When the holder of a put option exercises their put, they're choosing to sell stock at the strike price. Every transaction has two sides. When the put holder exercises their right to sell, another investor, known as the put writer or seller, is assigned an obligation to buy stock at that same strike price. So the put holder exercises the right to sell stock, and the put seller, otherwise known as the put writer, is assigned the obligation to buy stock. So here are the key takeaways. A put option gives you the right, but not the obligation to sell a stock at a set price. This makes it a valuable tool for when you believe a stock's price will go down. A put option becomes more valuable as the price of the underlying stock falls, and the lower the stock's price goes below the strike price, the more valuable the put becomes. A put option is considered in the money when the stock price is below the strike price, and therefore all in the money puts have intrinsic value. Out of the money puts do not have any intrinsic value. Their value is comprised of only extrinsic value. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, costs, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions can change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.